Steve, good morning as well. I want you to reaffirm the direction of the 10-year note. You know Jan Loeys at JP Morgan with that essay over the summer hypothesizing about a 10-year yield under 1% and even driving ever lower. Is it possible, Steve Major, that interest rates could drive ever lower?
Yeah, we're forecasting 50 basis points for the 10-year Treasury. It took us a month or so to commit to this because obviously we had to do some work, do some analysis. But the pandemic effect obviously gives us zero bound for a while. That's like a magnet putting yields across the curve down. But also, more academically, there is the R star, which could be 100 basis points lower than we previously thought. So the Fed was guiding to R star around 50 basis points in the medium to longer term. So they're probably with a negative number now. We might have to wait until June. They might give us something now. But I would suggest that the pandemic effect has taken R star down a long way. Now, if that's the case, we need to be resetting our sights on the range for the whole Treasury curve. So I think we will now live below 1% for a very long time.
This is extremely important, folks, that Mr. Major talks about 100 basis point, 1 full percentage point shift, and Mr. Williams are starred. Steve Major, there seems to be a persistency to that. How long do you perceive this disinflation or even outright goods deflation that we will see? What's your timeline of that diminished R star?
Yeah. Okay, so there's 2 points here, Tom. First of all, the Japan effect. The Japanification was underway anyway. This is a decade or so long trend, and we can talk about excess debt driving growth and yields lower. We can talk about disinflation. We can go into all kinds of themes on this. The new development, I think, gives us disinflation and deflation as for the next year or so. We can talk about inflation later. I mean, most of us have this concern at the back of our minds that with all this money creation, eventually some of it can get out, and therefore you get a conventional inflation move. But I think we're a long way away from that, and central banks have got the tools to manage it. So I'm more concerned with doing this one thing at a time. It's disinflation and probable deflation first, and in a couple of years, maybe we could see some inflation pressure, but I'm not even convinced I could argue for that with my hand on my heart. I mean, I can give you the stories, but I'm not sure I can believe them. So it's disinflation first, Tom.
Okay, but I mean, disinflation, Stephen, it's Francine, good morning, with a specter of deflation. What would a deflationary pressure actually look like for the world economy? Well,
yeah, you hear the word and you probably think of it in a negative way. But look, I was explaining this to my colleagues recently. If prices go down by more than your wage goes down, you're actually better off. So, you know, you could take a 10% wage reduction if the prices of everything went down 15%, for example. I'm not saying that's going to happen, but yeah, there is a good deflation. You could arguably say that Japan hasn't had a bad time the last couple of decades. They've had 20 years at zero. The 10-year rate projects 10 more years at zero, and people seem to muddle along over there. So it's all about how you measure the success of the policies. It's the measurable criteria. I wonder whether the goalposts might start shifting over time. I mean, what happened to inflation targeting, by the way? There was supposed to be a framework review. What's happened to that? So if you were to slowly shift the goalposts, I'm sorry to use the football analogy, but you know what I mean, then maybe you could say that there's been a successful outcome at some point in the future.
Stephen, can you talk us through how much more stimulus of the fiscal kind and the monetary kind we'll need once the economies pick up? So, what we've had so far from the Fed and the others, is it just to deal with the crisis, and then we need a lot more to make sure that the economies, stay on the right path?
Yeah, the numbers are huge, Francine. So around the world, you're looking at double figures, so 10% plus of GDP fiscal loosening. But of course, it's more than that. It's probably heading to 15 to 20% in some countries. And this is just to catch up with the downward move in the economy. So the fiscal moves are just trying to fill the hole. The trouble is, what multipliers are we assuming? So the fiscal to growth and the fiscal to employment multipliers are not linear. There's a certain convexity in all of this. So, you create $100 billion, it doesn't make the economy grow $100 billion. It's less. So the authorities are racing to catch up to fill the hole that's been created.